Welcome, everybody. I'm Mortgage by Rue, and I'm here with my guest, Kyle Williams from Velocity 1031.
Awesome. Thanks for having me, Peter.
So Kyle and I we met about a couple months ago, and we started doing a couple lunch and learns. And so I actually learned a lot. I thought I knew enough about 1031 exchange, but until I sat through some of these classes that Kyle was teaching, I learned a whole nother side of 1031 that I didn't even know existed. So, investors, buying properties now are starting to make more sense because rates are starting to come down, right? So now numbers are starting to pencil out, right? And so investors think of, they're basically business owners, right? And, one of the books, Rich Dad, Poor Dad from Robert Kiyosaki talks about what is the biggest expense in a business? Taxes. 1031 exchange correlates directly to taxes. So, well, first off, Kyle, tell me a little bit about your background, school, whatever you want to share.
Yeah, Peter. I've been in finance, some sort of finance, for about 20 years now, since I got out of college. 1031s are just, it's really a niche area that a lot of people don't know about it. I've always loved numbers. I've always loved, the financial side of things, but I get to do a lot of public speaking, get to meet great people like yourself. So it's really cool. But yeah, in terms of my background, it's been a lot of numbers and a lot of finance.
Yeah, similar to me. I mean, I went to school and had a degree in economics. So definitely numbers is always something that's intrigues me. And that's why I'm in mortgage, right? But so let's just dive into 1031 exchange here. So first of all, just briefly, for mortgage, let's say 1031 exchange 101, what is a 1031 exchange?
So a 1031 exchange, if you're not familiar, allows an investor, it's really a process that allows an investor to sell their investment property and use all the equity, not just the after-tax equity, to reinvest into bigger and better investment property. And it could be for a multitude of reasons, right? Like a lot of investors have different motivations. Some may be worried about cash flow. Some may be worried about appreciation. Some may want to start like a new depreciation schedule. There's any number of reasons people exchange, but when they sell that investment property, they're deferring the taxes. So they're using all that equity. They're keeping more money working for them longer when they reinvest into new investment property.
Yeah. And so who would benefit from a 1031 exchange? Because I always get asked, hey, I'm selling my primary residence. Can I do a 1031 exchange?
Yeah. So a lot of people can do 1031 exchanges. Let's start with who can't do 1031 exchanges. Like you said, people selling and buying primary residences, they have their own part of the tax code that falls under Section 121. Second homeowners, flippers, builders and developers. But other than that, if you own land, that's investment property. If you own rentals, commercial, retail, and you can really get off into the weeds with mineral rights, air rights above buildings, cell phone towers. A lot of different types of investment property qualify for Section Code 1031 and the deferment of taxes on that sale.
Wow. Okay. That's a lot of information. So, you said flippers. So, I know a lot of investors that do flips.
Yep.
Why wouldn't that be considered a 1031 exchange eligible?
Great question. So the IRS has said that to qualify for Section Code 1031, you need to hold with long-term intent for business or investment use. Well, what does that mean? The IRS hasn't really defined it. It's ultimately up to your CPA to determine what long-term intent means. For many CPAs, they would say if you hold for a year, you're reporting rental income or business income from the property, you're probably okay. More conservative CPAs would say wait for 2 years, right? There's aggressive CPAs that have had clients that get unsolicited offers and they've owned the property for 8 or 9 months, but it's already in business use or investment use with tenants. And the CPA says, yeah, go ahead and do a 1031. Your intent was clearly to hold this long term. You just got an unsolicited offer. So that's one of those things, because it's not specifically defined in Section Code 1031. We always encourage people to loop in their CPA or their accountant to discuss what exactly long-term intent means to them in their case.
So it's kind of sounds like a gray area.
Definitely. And Section Code 1031 is full of gray area, but that's probably the grayest of the gray area when it comes to holding period and really long-term intent for Section Code 1031. Granted, yeah, if you've had a rental for a dozen years, that's obviously fine, right? It's once you get to the shorter end of the scale, 6 months, a year, 2 years, where CPAs definitely need to opine on that and let you know, yes, I'm comfortable with you filing this as a 1031 exchange, or no, I'm really not.
So let's get in the weeds of 1031 exchange. So how long do they have to identify a property, and how much time do they have to close on that property?
After they close on their sale, they have 45 days to what we would call identify new property to purchase. After close of escrow, that starts the clock. So from there, 45 days to let us know in writing what you intend on purchasing. Sometimes exchangers say, I want to identify a property in Kirkland, right? And it's like, well, which one? Well, I'm not sure. I'm looking in Kirkland. That doesn't work. It's got to be a specific legal address or description. In the 45 days, there are really no extensions unless you're directly tied to a federally declared disaster. There's some nuance around that in itself. But for most people, there are no extensions. So if you find a property on day 46 and it wasn't identified, you can't buy it. So everything has to be buttoned up by day 45, meaning you know what you're going to purchase. Do you have to be under contract? You don't, but it's smart to do because, especially in our market, in King County, for example, if you identify a property on day 42 and you're not under contract, on day 46, it might be under contract to someone else, and you can't go re-identify at that point.
So you have 45 days to identify the property. So can I, as an investor, list 100 properties?
So technically you can. There's different rules that you have to follow for identification. If you were to list 100 properties, most likely you'd use what's called the 95% rule, meaning you could list 100 properties, but you'd have to close on 95% of them. Otherwise, the whole exchange would fail. Many investors use what's called the 3-property rule, meaning they could identify up to 3 properties of any value to purchase, because that's what a lot of investors do. They're going to sell one, maybe buy one, and have a backup, for example. Ultimately, though, they have 180 days to close on what they've identified. The 45 and 180 run concurrently. So after the 45 days is up, there's an additional 135 days following that to close on what you've identified. And around here, a lot of people will say, well, I need longer to identify. I don't need 180 days to close. Why does the IRS say you need 180 days to close? Well, oftentimes people will buy a new build and they'll need that full 6 months to close on it because it's not going to be finished and they're not going to be able to close on it for 5-6 months. So if you need the full 180 days, it's there for you. It's just, the average exchange may look like someone identifies a property on day 30 and then they close on day 60, right? That's probably more of like a run-of-the-mill normal type exchange.
Mm-hmm. Okay, so any exceptions to the 180 days?
Not unless you're directly affected by a federally declared disaster.
Okay,
and like I mentioned, there's some nuance around there, but this Hurricane Helene that just rolled through Florida, it's not like people up here get extensions, right? People in like North Carolina or Georgia, wherever the counties were that were affected by the disaster, the federally declared disaster, they would get extensions. But up here, we wouldn't unless you were directly tied to that. Like you had identified a property, you couldn't close on it in that area, something like that.
Mm-hmm. Well, that's just like a direct example because usually those are like one-offs, right?
Yep.
But we have one going on right now that could fit within that exception.
Yep, absolutely. Hurricane season is generally when we see extensions, but like lately, we've seen them for wildfires too. There's been flooding. I'm not going to speak as to the rate of natural disasters, but seemingly it seems like we've seen more the last few years than before.
Yeah. One of the things that I hear a lot is like kind of property. Can you kind of explain that? Give us more details on that.
Yeah. So like kind, when I was talking a little bit earlier about what qualifies, those are all like kind properties, meaning you can exchange out of one real estate asset class and into another. So to the IRS, there would be no difference between 50,000 acres of raw land in Tennessee and the Space Needle. It's what's called like kind, meaning they're both technically investment properties. And so one thing we've seen, if there's landowners out there, landowners often do 1031 exchanges. I mean, there's great reasons for owning land, but many landowners, they basically just land banked it and they've owned it for 30 or 40 years. And, they'd love to sell, but they'll get a huge tax bill. No one has ever told them, hey, you can sell this land, defer all the taxes, buy a rental, start getting the tax benefited appreciation all through a 1031 exchange. So there's a lot of really cool things. But yeah, in terms of like kind, sell land, buy rentals, sell rentals, buy retail, sell industrial, buy multifamily, right? So all those things are all technically investment properties. Therefore, you can exchange in and out of any of them.
Mm-hmm. So you can get a single family residence, sell it, and then buy a commercial retail building.
Absolutely. We see a lot of people do that they may have like a fourplex or something, and they've got a ton of appreciation on it, and they're like, hey, we'd like to go into like larger multifamily, or we'd like to go into retail, right? Even 30-year ground leases technically qualify. We did an exchange recently where someone bought a 30-year ground lease for a Taco Bell. Treated as fee simple property. It's exchangeable. It's like kind. So like kind is a pretty broad definition. If you're not comfortable with with the asset class that you're in within real estate, like land, for example, exchange into something that better hits your goals, right? Maybe you're sick of rentals. There's actually ways where you can go passive now into what are called Delaware statutory trusts. Where you just would basically collect a check and not have to worry about any of the active management. So there's something, no matter what your goals are, there's something that will hit those goals within the real estate world.
Yeah, that Delaware statutory trust is one of the things that I learned from you personally, where I didn't even know that was an option.
Yep.
So can you go into more detail about the Delaware trust?
Yeah, so I've got to be a little careful here. Delaware statutory trusts are technically securities, even though they're exchangeable and treated as real property, which they are real property. You have to work with a specific type of financial advisor that handles those types of DSTs. So I would encourage you, this is not a solicitation to buy by any means. Work with a financial advisor. This is not something that Peter or myself would ever guide you on. But Delaware statutory trusts, from a 40,000-foot view, are essentially just fractional interests in institutional properties. You could have, you could be a 1.84% owner of an Amazon warehouse in Colorado Springs. You could be, a fractional owner of self-storage portfolio. You could be a fractional owner of a triple net lease portfolio where the underlying tenants are triple net leasing the properties that you own. You're just a fractional owner in that portfolio. DSTs, there's definitely pros and cons to them. I would encourage everyone to weigh the risks. That being said, they even make a great, really backup in some cases, but also with leftover money as well. Because what we see people do is they may sell that duplex in Kirkland for $1.2 million, and they may find something that cash flows, a rental that cash flows really well out in North Bend for $900,000. Right, but they still have $300,000 left over to spend. So then that money will go into a DST as kind of leftover fund. So some people choose them as really a first line, first option. Sometimes it's a backup. Sometimes it's just leftover money. But DSTs can definitely make sense in certain portfolios.
Yeah. I mean, I've heard of a lot of these DSTs. I don't want to put a number on it, but the range is you can get double-digit returns on these DSTs.
So, yeah, I wouldn't. Historically, many of them have had double-digit returns. I mean, going forward, who knows what the future holds? It's. I don't want to make future assumptions based on historical returns, but yeah, it depends on your comfortability, how much risk you want to take, because I mean. Student housing the cap rate may be higher than like an Amazon warehouse, right? Like you're probably taking less risk when your tenant is Amazon versus tenants from student housing, right? So it's all about risk versus reward, which is, again, why you have to work with a financial advisor, weigh out the risks of each DST and see if it makes sense. Because for some people, it could definitely be too risky.
Yeah, I think one of the reasons why it intrigued me was you can get the returns and not have to be a landlord. You don't have to go out there on fix a busted pipe or something.
Yeah, and that's what's great is there's still a lot of people, even older people, that love real estate because it's tangible. They want to be able to go out there, touch it, fix it, tinker with it, whatever the case is. But oftentimes it's like, yeah, I don't want to do that with 3 or 4 portfolios. I would love to do an exchange into like a duplex, for example, and then maybe a DST for some of the funds as well. So it just allows you to diversify too, and geographically as well. Mm-hmm. A lot of people own properties around here and they think, well, it's not realistic for me to manage properties or figure out what to do in Nashville, Tennessee, right? What to look for, who to talk to, that sort of thing. So this DST that just opened in Nashville, Tennessee, for example, this is maybe my way to geographically diversify my portfolio.
So is your money tied up for a certain amount of period with the DSTs?
Yeah, with DSTs, it really depends. They are not liquid. It really depends on how long the projected holding period is. DST may estimate this is going to be a 5-year hold. If they get an unsolicited offer in 3 years that they can't say no to, they'll probably sell it, right? Maybe the market's down in 5 years and they say, we're going to hold on to this for another year, see if market conditions change. But they're not liquid by any means. I mean, real estate by its nature isn't, right? If you own a rental, that's not liquid. You'd have to put it on the market, sell it, close it, etc. But DSTs are definitely not liquid at all. Like you need to expect to hold 5, 6, 7, 10 years, whatever the holding period is for that DST.
Mm-hmm. So I think one of the biggest reasons why people don't do the 1031 exchange is because of you have to identify the property within 45 days. I mean, what are you seeing right now?
Yeah, it's tough in this market. Not a lot of inventory, but it's been tough for a long time in this market. The 45 days it comes and goes so quickly for investors in an exchange. 45 days to you and me just sitting here, yeah, that's a month and a half, right? But for them, it feels like a week because they need to get under contract. They're panicking. They've got a huge tax bill. So the 45 days, because it's set in stone, I always encourage people, start looking sooner rather than later. Don't even wait for your property to close. Like start looking now. That way, if you want to close a week after your sale closes, perfectly fine to do. You don't have to wait 45 days to actually tell us what you're going to buy. I mean, you can be lined up on a replacement property even before your sale closes. So definitely start looking sooner rather than later in the process. Some people want to wait till their property closes. Their sale closes before they look. That's fine. We just encourage people, know the market, because if you haven't sold a property or bought a property in a few years, it's going to shock you how little inventory there is, and especially if you're looking geographically or you're looking for a specific cap rate or specific area, right? What you see may just not be out there, so you're going to need as much time as possible.
Yeah. So let's talk about some case studies, some things that you've experienced personally. Talk about a story about how someone benefited from a 1031 exchange.
So this, let me tell you about who benefits, because there's been a few stories like this. A lot of people think 1031s are only for the wealthy. Only real estate moguls, et cetera, only people with large real estate portfolios can do 1031s. Not the case. 1031 is really probably the greatest wealth building tool for the middle class, because it allows especially younger investors to buy and sell over the course of their entire life and keep deferring taxes. But in terms of stories, the stories that I like, the exchangers that I really like and remember, younger people that they bought their first rental or piece of land years ago, they made some money on it, and now they're moving up. Now they're going to sell it, defer the taxes, and buy a duplex, right? They're building their wealth through real estate, which is really, really cool for younger people. And, just a great way to balance your portfolio. A lot of people are very heavy into real estate. That's their only asset class. But many smart people diversify too. And real estate's just a part of that holding.
Okay. Let's talk about the opposite of that. So a story about someone who didn't do a 1031 exchange, and ended up being detrimental for their long-term goals.
So Yeah, this pops up a lot. I feel like this happens literally once a week where someone will call and say, Kyle, I want to set up a 1031 exchange. I've heard you're the guy to talk to. Say, great, set it up. And I'll say, where's title and escrow? And they'll say, oh, it closed last Monday. It's too late to set up the 1031. So if there's anything to remember today, make sure you set up your 1031 before close of escrow. Ideally, once you're under contract and escrow is set up, but as long as it hasn't closed, it's not too late. If it's already closed, it's too late. This happens all the time where someone will want to set that exchange up, and I have to tell them, you've already closed. It's too late to set up the 1031. And they don't understand. They say, oh, I thought it'd be easier to set up after I close on my sale. Mm-hmm. You can't set it up at all after it closes. And sometimes these people have huge tax bills. Mm-hmm. I mean, if you have, they could have bought a duplex in Ballard 20 or 30 years ago for $200,000, $250,000, $300,000. Now it's worth $1.3 million. They've made $1 million on it. They're going to get killed in taxes.
Yeah.
All because they didn't set it up in time. So that's super important to know, is that just make sure once you're under contract, the 1031 gets set up, because once it closes, it's too late to set up the 1031 exchange.
So if a client wanted to come and set one up, how long does that take?
So we can do everything very, very quickly and efficiently. We've got an unbelievable system and technology that's unparalleled in the 1031 industry. So even if they haven't closed that day, we could get it set up that day, as long as they haven't closed.
That's very cool. Like, especially someone who's just, I just heard about this and they want to jump into it.
Yep. And obviously we like to have as much time as possible so we can dot I's and cross T's, because what if someone says, Kyle, I want to set up a 1031 exchange on my investment property, and we set it up, and then come to find out it's a second home, which doesn't qualify. It's like, well, you just paid us to do an exchange that you can't actually exchange. Mm-hmm. Like, if we would have had more time, we would have discussed that, and I would have told you that this doesn't qualify. But because we were rushed, we had to set it up anyway, just almost as an insurance policy. So that's why we want to be involved sooner rather than later, so we can dot I's, cross T's, talk to their CPA, talk to their attorney if need be, work with a broker, work with a lender, make sure everyone's on the same page.
Well, I think it's pretty cool about your company is how it goes into an account and you can monitor it. That's not the same with all 1031 exchange companies, right?
No, it's not. What we do differently is that we actually have a portal. As soon as clients close on their sale, they can log into their portal, view their account. Their funds go directly from escrow into an individual trust account we hold on their behalf. So they're not commingled. But most importantly, they can see their funds. There's 100% transparency there, which you should always have transparency. It's your money. We're just holding it for you. I know a lot of other exchange companies will print a number on their letterhead and say, here's your proof of funds. Is that really proof of funds? I mean, what bank is it? Show me an account from the bank, right? So it's super, super important that we provide that transparency and let clients know exactly where their funds are at. Because if we weren't providing transparency, you'd have to ask yourself, why?
Yeah, I think that's what's great about your company, because when you think about it, it's almost like it's not as regulated as it should be, right? I mean,
correct.
Are you allowed to commingle funds as a 1031 exchange company?
Absolutely. It's
that scares me as an investor.
Yeah, technically in the state of Washington, they should be in individual separate trust accounts, but it's not that way. It's not that way at all. We've seen many times where, if you watch the show American Greed, there's actually a 1031 episode where there's like a Bernie Madoff of 1031s down in Florida a number of years ago who took off with client funds. So, it's not just fraud. Sometimes there was a large 1031 company, Land America 1031, that was taking people's money and putting them in auction rate securities like high yield. When the market crashed in 2008, they ended up losing a lot of client funds. Oh, wow. And that was like a large, what was reputable company. They weren't doing anything. Well, it was more unethical than anything, but they didn't abscond with the funds. They just invested the funds and lost money, thinking high yield safe. We'll just put money here. We can make a few bucks on it, which is super important to know where your funds are at, because if you're working with a 1031 company, they can tell you all day it's in a bank account, but is it really? Can you view the account? I mean, anyone can say it's anywhere, but you need that peace of mind. You need to be able to view your account 24/7. And again, if you can't, you need to ask yourself why.
So with your company, Velocity 1031, does the money accrue interest as soon as it hits the account?
Absolutely.
Okay. Okay. And then is that taxable?
It is taxable. Yes. Yep.
Okay.
Yep. They're put in interest-bearing accounts. Interest varies on size, bank use, et cetera, but they are interest-bearing accounts. Interest is taxable.
So sounds like more like high yield savings account type.
It's definitely not. It's just an individual trust account. People will ask us to put their funds in high yield savings accounts so they can make more money. We don't do that. It's really, you work with us for safety and transparency. That's it. Yeah. We're not going to get greedy and put your funds in Bitcoin or try to invest your funds because you want us to. There's plenty of companies that I'm sure would be glad to invest your funds for you. That's not our role. Our role is just to make sure your funds are there when you need them.
You know, there's been a lot of talks of buying and selling real estate through Bitcoin. Do you see anything like 1031 exchange intermingling funds with Bitcoin's cryptocurrency, I should say?
So, I mean, I guess it would technically be possible to do. I'm not familiar with any 1031 company that's ever transacted in Bitcoin. There'd be a lot of issues that I would have with that, because where's it going to be custodied? You know, even if it's at Coinbase, right? Like a publicly traded, reputable crypto broker, it's like you don't want to leave your crypto on an exchange, which is where you'd have to hold it, right? Unless you put it on a cold wallet and cold storage, and then it's more of like a nightmare logistically. But I think at some point, because that's the way technology is going, and more transaction, we've even seen real estate transaction. There's a real estate broker that I've worked with many times who did a real estate transaction in Bitcoin. I think it was the first one 7, 8, 9 years ago.
I remember hearing about that.
Hell yeah. Yep. Her client did one entirely in Bitcoin. So I think we'll see more of that in the real estate world. How it comes into the 1031 world, I don't know, but as it's adapted, I can definitely see, especially a company like ours, figuring out a solution for clients to hold their crypto. Again, it's not around the corner. It's not there now, but just the way is innovative as our company, our management is, I could definitely see that down the road.
Yeah. Well, let's talk about taxes, right? Have you heard of any new tax laws, real estate taxes that are coming down the pipe?
Yeah, so this does come up from time to time, because they've talked about 1031s a lot lately. President Trump got rid of part of Section Code 1031 through the Tax Cut and Jobs Act a few years back, because before that, 5 years ago now or whatever it was, you could actually 1031 anything held for business or investment use. You could exchange patents, artwork, coins, collectibles. Now you can only 1031 real estate. So part of 1031 was taken away a few years back. It's come up in the budget the last couple of years, hasn't been put through in the final budget to cap 1031 gains. So that's something that the government looks at. Do I think it's going to happen? Tough to say. Hopefully not, because 1031 generates a lot of money for the federal government. I think the 2021 Ernst & Young study said that locally, at the state level, and federally, 1031s generated $13 billion or so in taxes, because so much of the real estate world is derived from Section Code 1031 and people doing 1031 exchanges. So the government makes a fair amount of money in taxes off it. So I don't think it's going to go away. But that being said, hopefully Congress is not short-sighted and understands that this is not just for wealthy real estate people. This is for young people that want to build wealth in real estate.
Mm-hmm. I remember during COVID when NFTs were selling for millions of dollars. I mean, I can imagine like people trying to do a 1031 exchange to sell one of those.
Sure. Yeah,
They're worth nothing now, but I mean, at the time, it was a hot commodity.
Yeah, you could literally 1031 anything, rental car fleets, yachts. I mean, I think that was more of a tax loophole because you could have someone that owned a $250 million Monet and do an exchange for another piece of artwork and defer the taxes, right? So it's not like it wasn't the same as real estate is. I mean, the rules were the same, but principally it was different.
Yeah. Well, what are you seeing now in the real estate market? I mean, for me, I'm hearing more and more people interested in purchasing homes just because rates are starting to come down as an investment property. What are you seeing right now?
Yeah, it's kind of interesting because there's not a lot of inventory, right? A lot of people are locked in, whatever, 40 or 50%. You probably know the number, have under a 4% mortgage right now. Those people probably aren't going to sell anytime soon until they can at least buy something more affordable. A lot of people trying to time the market right now with interest rates. Mm-hmm. And most people I talk to say the same thing, that, hey, rates are going to go down. I'm not so sure. Rates, the 10-year treasuries ticked back up over 4%. Mm-hmm. And it was 360 a month ago or a few weeks ago?
A couple weeks ago.
Which is kind of the 30-year mortgage is kind of tied to that. So we've seen rates go back up, just like with the 30-year mortgage, it was down around 6, and what is it now, 635, something like that. I don't know, 640. So with real estate investors and even people buying their primary residences, it's like if you're going to hold long term, a lesson in futility is trying to time the interest rate market. Mm-hmm. What if interest rates go up? I mean, they started lowering rates in 1976 in another election year after inflation come down from the oil embargo, and thought inflation was under control. They started lowering rates. It wasn't. It was a huge policy mistake, and then they had to hike rates well into the double digits to get inflation under control. Could that happen again? Possibly. I mean, is inflation under control? I think a lot of people would say no. And so what would that mean? Well, we may end up having to hike rates again. So this could play out any number of ways. I don't even think the Fed Chair, Jay Powell, knows what interest rates are going to do over the next couple of years. But with people, especially buying their primary residence, but investors, it's like if you're going to hold this property long term, it's not a bad day to buy real estate. Just think of the people who would have bought a primary residence, say, in June of 2007 in Seattle. 18 months later, they thought that was the worst decision they ever made. If they still held it today, they probably have $1 million in equity in that property.
Yeah. Well, I think a lot of the new investors, what they look at is cash flow, right? A lot of times they look at cash flow, and that's directly related to rates. And so when they start hearing about interest rates starting to come down, it kind of perks their interest. Like, oh, now these numbers might start working out where I could buy an investment property and it will cash flow.
Yep. Yeah. And if the numbers don't pencil out as it is, if you really need rates to drop, as rates drop, more people start buying again. There's just not much inventory. So I would say if you're a long-term thinker, and this is a long-term investment for you, don't try to time the interest rate market, because guess what? What if rates go up? They've gone up the last few weeks since the Fed cut. What if they keep going up? You'll wish you could have gotten a 6.5% mortgage when you could, if mortgages go to 7, 8, 9%, right? But guess what? Maybe they go down. Maybe they go down to 4%. Refi at that point, right? If you're going to hold real estate long term, timing out an interest rate market is just it's tough to do.
Right. It's kind of like timing the stock market, right?
It's literally it's probably harder to predict, right? Because there are so many moving parts to bonds and to treasuries and the interest rate. The bond market is, I think, 10 times as large as the stock market. So with stocks, companies report earnings, this, that, and the other, but we don't get a lot of language from the Fed on what they're going to do. It's a lot of times it's a guessing game for everyone as to what interest rates are going to do. So I'd say it's probably the toughest market to predict. And if Jay Powell came on here today and told me what interest rates are going to do over the next 2 years, I wouldn't believe him. because I don't think anyone knows. It's just it's a very predictable market. So anyone listening or watching, they're not going to be able to time interest rates. If you do time interest rates, it's blind luck.
Well, Kyle, I really appreciate you coming on the podcast and sharing the information. I feel like if anyone is interested in buying and selling an investment property, Kyle is definitely the person that you want to talk to. So reach out to him. His information is below in the captions.
Awesome. Thanks, Peter.
All right. Thanks for coming on.